And we're live.
Okay, awesome. Well, it's pretty cool actually to be live first for the first time. Um, what did you think of the subject matter that we covered earlier when we were recording, talking about retirement?
That
What did you get from it?
that that average return can still hurt you. I've never thought about consistent returns versus average returns in that specific way before joining this space.
Mhm.
And it just even outside of retirement, like just because I'm not near retirement, but just planning, budgeting, relying on the yield for different things, maybe funding an expat, whether it's funding an expat lifestyle or just supplementing income, or just the second you go from average to consistent, it's like a new world opens almost.
Yeah, it certainly breeds confidence, right?
Yeah.
And
Yeah,
I
it gives
think
me the conviction to just throw money at it. Like there's no timing the market, there's no hoping, there's no, it's just the conviction's there. Now the question is, risk management with LTV, liquidity, staggering, all that stuff. But the conviction at base level is there.
well, that's actually such a big piece. Like when I hear you say that, I'm like, yeah, that's a big deal. Like having that confidence that turns that turns things into where you're essentially just looking at it and going, it's a total numbers game. I have such confidence in this thing that I'm just looking for areas where I can pull more investable dollars away. And that's where we get, that's why we see people who've been lending with us um, that own real estate start to liquidate the real estate and lend as they get older and they get closer to retirement. They start to, it clicks, right? They're like, wait a minute. I don't need to be a landlord. I can still be invested in the real estate, but I don't need to be the landlord. And it's yeah, that's got to be liberating for people, right? To get to that place where you have such confidence in the vehicle that it's just now, how much can I get in it?
And even those that take, they kind of want to have a firm grasp on their portfolio and they kind of do it yourselfers. Those that are very disciplined, you're not supposed to put more than you're not supposed to put more than 1 to 3% of your investable earnings in one particular stock or one particular play or one particular vehicle, and all these allocation rules you have to self-impose on yourself, because people that go all in, like on Tesla, for example, some do well, some kind of crash and burn, But with private lending, it's like you have way more of a stronger conviction. You don't mind allocating more than 1 to 3% of your investable earnings in a
You
deal.
can, and you can do it any way you want, right? Like if you're working with an administrator who can syndicate, meaning putting pieces of capital together to make one mortgage and being able to paper it all properly so everybody's protected and nobody's got an advantage over anybody else, and it's all just proportionate investing. It just you start to look at it and you're like, we can fit this into every rule like that you just talked about. So if you were to talk to someone, they go, wow, what about liquidity? You can go, I can create that inside this space. What about diversification? I can do that too inside this space. I don't have to go outside of the space to achieve any of those things. And you can even say, okay, well, what about having like, segmenting your portfolio so you have like very low risk, medium risk, and maybe a little bit of higher risk? I'd be like, no problem. First mortgages to 65% loan to value. How much of that do you want? And then how much do you want of first mortgages to 75% or second mortgages to 70%? And they would fit in that middle category. And then the last category would be, first or second mortgages to 80% of the value. And there you go. You got your 3 tiers, and you're going to get different yields on all of them. And you can combine them however you want to achieve your target yield. So it's such a flexible space because, I know this is not an all-encompassing statement, but I've always, as I've gone through this journey of like 18 years of doing this, I've always had this feeling like, if I learned one thing about investing in all through all this, it's that every type of investment is really just a loan with different terms and different conditions. Like it's all lending, right? Like when you invest in a stock, what are you doing? You're kind of lending money to the company and hoping they do something really good with it, so the value of the company goes up, which means your piece of it is more expensive, but it's or more valuable. But you're essentially lending money to a company. You're taking a risk on that company.
That's true.
You know?
Yep. Hey, a question from Neil Cameron.
Yeah.
Are you structured as a MIC or as a mutual fund trust, or do you just place capital for clients?
Oh, great question. So we are not structured as a MIC. We have a mutual fund trust being created that we are going to make available to wealth managers in 2026. But no, our path in private mortgages has always been what I think is the most difficult way to do things administratively, but that's syndication, where we can take your order, Nick, for $50,000 and somebody else's order for $50,000 and put them together and fund a $100,000 mortgage. We can also do that with 3 or 4 or 5 or 10 or 20 investors. We can do things in different pieces. So, for example, we could lend 80% of the value of a house to a borrower and then split that mortgage into pieces so that one group is in, their exposure is just to 65% of the value and the others are exposed to 80% of the value of that house, but they're getting a premium return.
Oh yeah, you
Right.
were
So
varying risk per deal. You were
yeah.
splitting depending on the types of orders you get, or what's the reason you would do that?
Well, there's a number of reasons why you might do it. I mean, to feed different mouths, right? Because you have orders coming in from different investors who've onboarded and stated their preferences. Somebody who, say, for example, like my mother and father, who are in their late 70s, almost 80 years old, and would want something very different than an investor like you, right, at your age. And so you're able to feed more mouths with the syndication model, where you can take a mortgage and split it depending on the appetite of the investors who have placed orders with you, right? So
Hmm.
it's an extremely flexible model. Obviously, like I said, a lot of administrative work behind the scenes to put that together and then manage it. It's easier to just put every mortgage into a pool, right?
Yeah. Well, I caught on to that really quick when I was looking into the space in 2019 when I knew I wanted to do this.
Mhm.
I was initially looking at mix, and it wasn't going on so much in 2019, but you do have this issue with gated funds where if a lot of capital goes into the MIC and it just needs to get out, and you know if certain investors are okay with higher risk, it affects everyone, because if that pool of deals, or if part of that pool of deals goes sour, everyone's funds get gated until fresh new
Yeah.
money comes in. Whereas with this, under the syndication model, I'm like, if someone wants to go, 12%, 85, 12% yield, 85% LTV, and second or maybe even third position or whatever they want to do, it's not going to affect me. Um, so
Yeah.
when I realized that, I was like, oh, okay, I really get to be the architect here.
Yeah, and listen, as a third party administrator, right, a custodian of people's capital, I think it's also important to point out that if you put money into a MIC and a lot of other people put money into the MIC and the MIC takes all the money in, they have to find a home for it. And they're starting to pay. There's a drag on cash flow as long as that money is sitting in the account of the MIC. So if somebody buys shares, now the MIC has the money, they have to lend it out and earn a yield. And if they can't, right, or there's not enough inventory that they're exposed to, they're not seeing enough deals, they may have to expand what type of deal they're willing to do,
Yeah.
right? So because there's downward pressure on the money, you've got to put it out because you're paying, you've pledged to pay a return to the investors. So, but we don't have that pressure because every mortgage is made to order, right? Every investment, I should say,
There's
is
a
made
queue.
to order. Yeah, there's a queue, right? So we've always just told people, look, as amazing as the space is, you have to find top quality inventory to put people's money into. Like you have, there's a lot of work to harvest enough mortgage applications that you can find those one or two diamonds in the rough. Because we find literally 1 or 2 out of 10 that we see. So with that, you're running a business. You also have to be willing and courageous enough to say to your audience, you can place an order today. It may take us a month to find you the gold, but we're not going to sell you silver, right? Where as a Mick would have pressure to put that money out, and you'll see a lot of Micks don't just do residential private mortgages, which to me are the safest and the simplest version of private mortgages that you can get involved in. But you'll see people move into commercial construction development because they can put millions out at a time and becomes like a valve. But all those mortgages come with different types of risk. So, it's I love the syndication model because I am the governor of what goes out, where it goes out, and we don't take people's money and hold it ourselves. We only put it into a mortgage when the mortgage is ready and cooked. You know what I mean? And it's passed all the tests and it's ready to go. And I think what our clientele have come to learn is it's worth the wait, because as soon as I get in, I'm getting a smooth ride and I'm getting a great yield and I don't lose sleep at night and all those things, right?
Follow-up question from Neil. Keep them coming, man. That's why we're here. So when the mutual fund trust comes on board, and if the borrower defaults, would you take over the property if the LTV makes sense?
Regardless of whether the mortgage sits in the trust or it's a mortgage that is syndicated with multiple investors or whatnot. As the administrator, our job is to manage any kind of default or enforcement activity. Now, what's important to understand is that it's rare. So we don't see a lot of default activity in general, and we see even less that go all the way through the process to where we get possession of the property. Why? Because it's incredibly strong collateral and borrowers don't want to give you their home. They don't, and we're not giving mortgages to people who when we evaluate it, look like they can't viably exit or maintain payments. So we've done those pressure tests. So it's very rare. But nevertheless, when it does happen, you have options. When you have the right to possess the property, you then have options. You can sell it, you can renovate it and rent it, or just rent it. You don't necessarily have to renovate it, but it's an asset. And so what you go through is a process of case by case evaluating this particular asset and looking for its highest and best use to serve your situation. Now, ultimately, as lenders, we're not in the business of holding property. So the first thing that we would look at is, can we sell it for enough to get what we're in it for, plus any interest that's outstanding paid? If we can do that, then we sell it. If that's a problem, right? If we put it on the market and we find, geez, the offers are so low that, it's not enough to pay the mortgage off, then you look at alternatives. And the alternatives, one of the nice things in real estate is when the market, sort of takes a downturn, history shows that it doesn't take very long to rebound, right? And to get that value back. So time becomes your friend. And so you look at strategies for being able to hold that property and service it for a period of time until maybe the market can help you. Or you can do something different with the property. You can try to put renters in it, for example, so make it an income generating property. If it generates enough money to pay the mortgage, then you can hold it for longer until the value comes back and the market conditions are more favorable for a sale. But that's the beauty of private mortgages against residential properties, in my opinion, is it takes 3 things to lose, and all 3 have to happen all at once. One is that the borrower has to stop paying. 2 is that the value has to drop within 12 months in a significant way, because we only lend a maximum of 80% of the value, and on average 70%. Okay, so we're pretty conservative that way. And then the third thing is the one piece that's in your control. You have to sell the asset at a loss, and you don't have to do that. You can hold the asset and do something different with it. So it's it's really comes down to, are you prepared to manage a situation like that? And that's the service that an administrator can provide if you don't feel comfortable doing it on your own.
Follow-up comment from Neil. He says, makes sense. I'm in a deal where I don't think the borrower will be able to get out of the deal. I'm learning a lot from your videos.
Hmm.
I don't think the borrower will be able to get out.
Yeah, if you're in a problem, Neil, like if you have a mortgage that you're in a situation, happy to talk to you at some point offline and just get the details. I might be able to give you an idea or two of things we've done in the past when things have happened. And we've been fortunate to be very good at solutioning, but it requires thought and some creativity sometimes. But maybe there's an angle that you haven't thought of yet. Who knows? Maybe not. I don't know your experience level. I don't know any of that, but happy to help if I can.
But Chris, you've mentioned in the past the lender not being able to get out, being sloppy. But what does it look like when the borrower can't get out? Does he mean like is it just
He's saying,
another way of
yeah,
saying default?
I think what he's saying, and maybe he can confirm, but I think what he's saying is the mortgage is probably matured, but the borrower can't pay back, right? He can't refinance at a bank. He
Okay.
hasn't sold the property yet, but he's probably making the payments, something like that. That's what I would assume that to mean, is that, you lent this money for 12 months, right? And at 12 months, you're like, okay, time to pay me back. And the guy's like, I can't. Well, why can't you? Well, because I tried refinancing with a bank and they won't say yes. And, this is my family living under here. I can't move. I don't want to sell. And so now it puts the lender in a difficult spot, because technically at the 12-month mark, unless they've agreed to terms of a renewal or an extension, that mortgage is due, and it's a default, an event of default, to go past maturity without paying the principal back. Now, the question facing the lender in that situation is, okay, what do I want to do? Do I want to demand the loan and then go into the enforcement process? And you look at it today, for example, generally speaking, my philosophy is keep it away from the lawyers as long as possible. Try to work it out between the borrower and the lender. When does that become impossible? When communication breaks down, or the borrower doesn't want to talk anymore, or is, something like that. But if you can work it out, because you look at the cost of going the legal route, it can be punitive. So you have to be careful there, right? You want to make sure, because lawyers are going to get paid before you get your money out in a sale.
He says he's at 85% LTV. Okay,
so difficult, right? Very difficult. I'm not surprised that it's difficult for that borrower to refinance today. It's difficult to find 85% anywhere. Now, maybe when Neil lent him the money, 85% wasn't such a big deal because the market conditions were different. I don't know. But 85% is difficult to refinance, and the market isn't helping because we're not sure where the bottom is yet. I think it's getting close, but properties are still in some places depreciating. So you have to be smart, okay, in a situation like that. You're at 85% loan to value. You want to keep the waters calm. The best thing that could happen is that the borrower continues to make interest payments every month. I don't know if that's happening for Neil. When we're doing this,
do you want to have him on, or do you want to do that another time?
Oh, I don't know how this works. So you tell me. Like, if we can have him on, I'd happily have a conversation with him. But maybe
let us know if you want to come on.
Yeah, or he can just tell us, is the borrower still making payments? Like, have they been missing payments is a better question. That's what I'd want to know first. This is a conversation I would have with my staff. So, okay, somebody is coming up to maturity. They can't get out. They can't refinance out. Have they made all their payments on time?
Have they made all their payments on time?
That's what I want to know. I want to know the track record.
He says they're still making payments.
Beautiful. Don't upset the apple cart would be my first approach. Now, I would think that through, because I don't know all the details, Neil, but immediately when you say that, I would say, okay, we're at 85%. We have to acknowledge there's more vulnerability for you at 85% loan to value in a market like this. And you should at this point be wanting to work with the borrower. And if the borrower continues to make interest payments, fantastic. If you haven't renewed them, you may want to enter into a renewal agreement, because you don't want it to be open-ended where it's just can go on forever. You do want to have a next deadline. Now, you look at the market today and you might say it's unlikely that this property is going to appreciate to where we're
Where are
under
you,
80.
Neil? Where are you in Canada?
It's unlikely that this property is going to appreciate to where the mortgage goes under 80% loan to value and the borrower has more options for refinance in the next 12 months. So I would be keen to renew for 12 months and keep the interest payments coming to buy myself time for the market to do me a favor. That's how I would be looking at this.
He says he's in Ottawa and the property's in Scarborough.
Okay. So yeah, I think, if the borrower's paying every month, that's number one. When that changes, then I take pause and I start to look at things differently. But I'm still trying to work with the borrower to buy time until the market is more conducive for the loan. I think you took a lot of risk here at 85%. That's my opinion. I'm being honest with you. We don't go above 80, but it's not unmanageable at 85. It just may take you a little longer to get out because the borrower just doesn't have a lot of options. Remember, 85% loan to value is an insured mortgage in Canada at a bank. You have to get insurance for that to go over 80. So that's why we keep under 80. So something to think about for your next one is maybe to stop at 80. But you're in this right now. I think this is workable because your borrower is paying every month and there's no issue. What I wouldn't do is I wouldn't put him into a default position by charging some sort of exorbitant renewal fee that they can't pay. If you are charging a renewal fee, I endorse that because I think you should get a fee for the second year. But maybe you want to make it easy for him to pay. Either put it on the account and agree to take it at the end, or take it in installments, or take a little bit up front and things like that. So I wouldn't want to hurt myself by charging a fee that the borrower it's going to make them start to miss payments. So I'd be cognizant of that. So the first step would be talking to the borrower, just talking to them, having a conversation. What's your circumstances? What's the situation? What's the outlook? What are you planning to do to refinance this later? And how is everything? Are you able to manage everything okay? Are you running into it? Keep the line of communication open, keep the waters calm, keep the interest payments coming. I think if you do that, you'll find you'll be in this longer than you want it to be, maybe, but it should work out. Like, it really should.
Maybe this is like towards the end of the term and he didn't start out at 85.
Right, exactly. It's possible that he started at 80 and now he's at 85 because the market depreciated and the value isn't there anymore that it was. The value has changed. So that's totally possible. You get stuck, right? It happens from time to time with us too. And you want to pay close attention to those. But the number one thing, now just to simplify it, is the borrower still paying? If they are, great. Keep that relationship calm with open communication. Work with them.
He says that's the case. He didn't start out at 85 and now we're here. Yeah.
Listen, lots of lenders are caught in these situations right now. And it's not dire. Like, it's not, you shouldn't be worried about losing right now. You just want to keep things moving, keep interest coming while the market does what it needs to do to recover. And I think it will.
When you hear 85, do you automatically assume a second, or is that not a given?
Yeah, I would assume it's a second mortgage. Yeah.
Okay, so as time goes on,
but if you started at 80, it could be a first or a second.
Okay, so as time goes on, the first is also getting paid down, and
yeah, presumably, right? So that's something to look at, is to think what is I don't know how much due diligence Neil has done leading up to the maturity date, but yes, that's something we would do. We would check what's the current balance of the first mortgage. We'd get a new appraisal. What's the appraised value today? And then we'd look at our balance and we'd redo the math and find out where we are LTV wise. And then we start to make decisions. But ultimately, you're in that 80 to 85 range. Obviously, the borrower is going to do everything they can at all times to exit to cheaper money. So that's happening. But if he can't, he can't. And so now you want to work out a set of renewal terms, right? A
Yeah,
renewal agreement says, hey, let's do this for another 12 months. You'll keep making the same payments. And listen, the fee that you paid in year one, you have to pay in year two, but we can be flexible about how you pay it, when you pay it.
the renewal agreement, because you mentioned not upsetting the apple cart. How do you approach renewal agreements? Like, is that an upsetting event? Like, is that a big
No, not
deal?
at all. I think it's, when you talk to a borrower, you just want to be real with them. So, we start talking to the borrower 90 days before maturity for a very good reason. Exactly what you're hitting on is, first and foremost, we just want to assess, hey, how are things going? Because 9 months ago, when we gave you this 1 year term, you told us you were going to exit this way and you had a plan, and we bought the plan. Like, we believed in it. We thought it was viable. So how are you doing? We're getting close, 90 days to go. How are things? Some people don't answer the phone. Some people don't call you back for a while, and you have to warm them up. An email, hey, listen, I just want to have a chat with you because I want to make sure that we work things out, and that everything goes well for both sides. You got to try to massage it sometimes, that they're afraid sometimes to talk to you. Other people pick up the phone right away, and they're great. They're happy to hear from you, and they share information with you. It's all really it's service. We're trying to build rapport with the borrower and let them feel comfortable, and tell them, hey, listen, guys, we're on your side. We want you to. You're our customer. We want to get rid of you, though, right? Like, we want you to go back to the bank, just like you want to go back to the bank, right? So we're on the same team here. So there's a process that we do, and I highly encourage it. You start talking to people once you've exhausted. So at first they say, hey, everything's good. I'm working with a broker. I'm going to get this refinanced. It'll be great. And we got 90 days. We got all kinds of time. Okay, fantastic. Listen, why don't I touch base with you in a couple of weeks and see how those conversations are going with the broker, and how things move along. You touch base a month later. You say, how's it going? Say, yeah, I don't have anything yet, but I'm still confident. And they're always going to believe that it's going to work out, right? Because they got a broker that they're working with who's telling them, hey, don't worry, I'll figure it out. You get to 6 weeks or 5 weeks before maturity, I start to change the conversation. So to say, hey, listen, I'm sure it's going to work out, but just in case it doesn't, right? We should start thinking about what we do if push comes to shove and you can't get refinanced. What do we do here? Maybe we should work out terms of a renewal agreement as a backup.
Are you saying that regardless of the borrower's circumstances, the broker's kind of being agreeable and cheerful throughout the whole thing, or
You don't know, but
okay.
hope springs eternal, right? And the borrower at that stage wants to believe they're going to be able to go back to the bank, and sometimes doesn't know all the ins and outs, so they're dependent on a third party, a broker, who is until they're out of options, is going to paint as rosy a picture as they can, I think, to keep the person calm, and so on. So, but you start to change the conversation and start to get prepared for the backup plan, which is potential renewal. Now, sometimes I don't want to offer a renewal because the guy's missed 2 or 3 payments, even though he got back on track. There's symptoms of a potential problem. So you may look at things a little deeper and make a different decision. But listen, if the borrower doesn't have anywhere to go, and you assess the sales option and it looks tight, or it doesn't look great, then you really have to, you have to really work with the borrower. And that's what we do.
Is communication something you've opened up, Neil, or you kind of, they're paying, so you haven't made a big deal about it so far? That'd be good to know, I think.
Yeah.
Because when the payments keep coming in, I
And
guess
I
lenders
have to
are
say,
happy
like,
to.
it's very important to say, not a lot of lenders that I know do what we do. They don't.
Hmm.
Like, a lot of the mix and whatnot that I know, they just write loans off. I hate to say that, but it's true. And it doesn't affect the investors unless it happens in a catastrophic fashion, like multiple, but we just don't. Like, we just work with anybody. It's rare. We have very few that are a problem, but we just work with them because, I mean, from an ethical point of view, nobody wants to kick anybody out of their house, for one. I want the borrower to be successful. I want the borrower to access the equity in their house because we were able to help them. I want my investors to earn a premium return for the same security the bank would get. And I want the borrower to only be here for a year, maybe 2, and then have used the equity in their home to change their circumstances enough that they can go back to a bank. That's what we want. So, when trouble hits, you don't just abandon all that and take the heavy hand off the wall and hammer the borrower with it. We try to work with them. Now, are there circumstances where it becomes very difficult to work with someone? Yes, it can happen. It's happened once or twice in our time. But if you manage those problems well from the beginning, we've been able to extract ourselves from every one of them safely.
Neil says, I have been in constant communication. There was a time when the borrower was missing payments. So yes, I have worked with them. I also have a heart and don't want them to default.
Man, this guy's the right guy. This is the right kind of guy. I'd love to work with this guy. He just, that's the right approach. You'll be successful if you do that. Keep that good level head on your shoulders. Understand sometimes stuff happens and we just have to be a little bit compassionate and to a point, patient to a point.
And there is a but he's like, when I am ready to retire, I would probably move to a MIC or a MFT, mutual fund trust, I'm guessing.
You don't necessarily need to move to one of those vehicles. You could, and we are setting one up that's just like almost tailor-made for exactly what he's saying. But you could still just work with an administrator and have them do it for you. And essentially, you'll make 100% of the returns, and they'll make the fees. That's the relationship, right? So you can hand it off, outsource it if you want.
Yeah. Probably move to a MIC or MFT where I don't have to worry about missed payments.
Yeah. Now that is a benefit for sure. Like of a pooled vehicle is that, the payments either stop for everybody because there's a real problem, like you said, a gated problem, or you get them on a regular basis. But to be honest, we have very few interruptions, really do. So, but I get it. I get what he's saying about the pool vehicle, and he's not wrong.
When I'm ready to retire.
Yeah. Good for him. I'm glad he joined. How do people find out about this?
I don't know if Neil's a subscriber. Is there a way to see? If he is, then
you should tell him, Neil, you should join the Magnetic Forum. Go to the school community.
Yeah, and the
Magnetic Forum. It's a community of all of our investors, and you'd probably learn a lot there. And you'd like to see what's going on. Probably just be curious. You could join.
Let me just paste the link.
It's by invitation only. So if you go to join, I'll approve you. Somebody will approve you.
I'll just paste a link in the chat now.
Yeah, perfect. It's a good idea for someone like him. And then we can chat too if you want. If you have any questions or concerns about any of the deals you're in, you can always just post it in the community and I'll give you some thoughts and the other investors will see too. And it's a great place for everybody to just share information and ideas.
Yeah, so it's a free community, and in there, Chris posts his ongoing deals. So the ones that discharge, the ones that are in default, or the ones that are...
Yeah, and we just got started about a month ago, but we have like 75 people in there, and we're just like, we're testing different things, but we're posting like examples of deals that are in enforcement. What's happening with them? What are we doing with them? We post when something discharges and what led to the discharge. We post when something renews or when it extends and what our thought process on it. Or deals that we saw that we declined. We'll put up there as well, and I'll post like, this looked good when it first came in, and then I dug deeper and I saw this and this, and we decided not to fund it. So there's all kinds of fun stuff. We're learning how to use that space. But I think the investors like it so far. And obviously we have the Tuesday night, every other Tuesday night, we do the founders table call, which is cool. We're getting some good participation in that. So yeah, it's a lot of fun in there.
Yeah. What's cool about joining on the ground floor is that right now, all the people that got invited in there are current investors with Chris's institution, the Magnetic Capital.
Yeah.
And so you're literally going to be surrounded by Chris's investors.
Yeah.
You'll get to see what goes on behind the scenes.
Yeah. And we're trying to have fun with it, but bring more transparency to the space for people to learn what we're doing behind the scenes that they have no idea we're doing. Yeah. And I think it's going to breed a lot of comfort with our investors. That's what excites me. Yeah. Well, thanks for contributing, Neil. That's really cool that somebody just saw us and started typing in. It's great.
Yeah. Oh yeah, we talked about him having a chat with you, but like he can literally just join the community and then hop on one of the
Yeah.
bi-weekly calls, and like we have
Yeah.
lawyers on there. There's Chris's head underwriter that just did a call last time. Um,
Yeah.
you're not
That's
hijacking anything. You're good.
yeah. Yeah. No, it's cool. Well, does he know this is the first time we've ever done this live
Yeah,
stream?
this is the first one. So thanks for
So
joining us.
yeah, really cool. And maybe more people will. I mean, as my investors find out that we live stream, I'm sure they'll join some of these calls
Hmm.
and talk. But this is
If
a
you have
really neat idea.
if you have any other questions, keep them coming.
Yeah, for sure.
Uh,
So back to
yeah.
what we were talking about was retirement, right?
When did you start
And
thinking about retirement?
oh, it's funny. I don't ever think I'll retire, but I always think about retirement. But I think about I just think of getting to a place where if I decided, if I decided,
Retirement for me is work that I choose to do.
yeah, when you choose to do it.
Yeah.
That's the other piece for me. So it's like, let's say, for example, a magnetic continues on its current trajectory and gets to a place where the people are so good at magnetic that it doesn't require me to be there all the time. So I would have this freedom to do something else. And, let's just imagine that I have enough resources to do that. Well, I would still want to work, but I might start something else, for example, start some I don't know, some business idea I want to pursue or whatnot, and then take more time to do it. And if I wanted to if I was working hard on it for a month and then decided, yeah, you know what, it's kind of cold out, I think I just want to go south for a month, I could just go south for a month and pick it up when I got back. That would be freedom to me, because I'd be bored out of my mind if I wasn't pursuing something. But you pursue it differently, when you've got enough to survive, whether it fails or succeeds or any of that. That's freedom.
No, work that you choose to do when you choose to do it.
Yeah. Yeah.
No more of those no more of those Tuesdays like you had last week.
Yeah. Yeah. Well, hey, you got to do. We have a job to do to work for people. But this is I believe in this so much when it comes to people who are getting into their retirement years. I mean, I just don't know of a better combination of security and yield. And that's what you're looking for at that age and that time in life, is just the ideal combination of those two, because they're positively correlated. Usually when one goes up, the other goes up. You get higher risk, higher return. But in this space, we get this unique mix of sneaky good return with excellent security, and 50, 60, 65% uptick on similar vehicles in its security class. The fixed income side of things is just the yield on a private mortgage, a first private mortgage at the safest LTV, 65%, for example, pays 50 to 60% better than a GIC or a bond or a high interest savings account. So, I mean, how do you not look at it?
And you mentioned that seconds would start at what, 70% in general?
Yeah, I mean, for the most part, you don't see a lot of second mortgages at under 65% loan to value.
Okay,
Just
so
don't
let's say
see that many of
70.
them. Yeah, 70, 75.
And the yield starts at 9?
Yeah. Yeah. Well, our yields on second start at 10.
Start
10,
at 10. So you're
10
at
and
70
10, 10 and
LTV
a,
and your yield starts at 10.
yeah, 10. A 70% second mortgage would yield 10.
See, that's not super crazy risk to me.
No, it's not. No, it's not. It's outstanding. You're getting an outstanding return.
So you pepper a couple of those in, you can, bump up your average yield to like
Yes.
maybe.
Yes. If you took 65% of your money and you had it invested in first mortgages at 65% loan to value, paying 6.5%. Then you had 35% of your money in second mortgages to 70 or 75%, earning an average of 10. Okay.
Yeah.
So let's just say if you had $1 million, I just have to do the numbers on my pad. But if you had $1 million, you had 650,000 of it invested at 6.5%, and the other 350 invested at 10%. So your 350 is making 35,000 a year, and your 650 is making 42,250. So that's 35,000. You're making 7.7%.
Yeah.
on all your money. You're killing it. On $1 million, you're making 77,000.
Paid out every month.
77,200 salary every year. And get this, so I'm just starting to take a course personally on personal pension plans, because I happen to connect with like the godfather of personal pension plans, a lawyer who basically wrote the book on personal pension plans. And the biggest challenge with private mortgage investing is taxation, because the income made is taxed as like the same as employment income. So the personal pension plan, it's come to my attention, can have a dramatic effect on your tax situation when you're investing in private mortgages. And so I'm taking a course on it for the next 3 months. And I'm going to learn everything I need to know about the pension plans, because I already know everything I need to know about our vehicle. So once I understand how our vehicle fits with the personal pension plan, I'm going to be able to come out to all of investors and say, hey, how about we take that 8% average yield, and instead of turning it into 6 or 5 after taxes, it could stay at 8. What if we could net you out 8%?
Yeah, I want that. Well,
yeah, everybody does. Everybody does. So that's the problem. That's the central problem I want to try to solve next. And that's what, so I'm taking a course to do that. And I'm very excited about it. I just enrolled this week.
That is a good plan for the PPP. He also asks, what is the minimum amount for an investment? 50K.
Yeah, with magnetic, 50K, yeah. That's RSP, TFSA, or cash. Yeah. Is that Neil still?
Yep, still Neil.
Nice. I'd love to meet him. So I hope he joins the community, and then I'll get a chance to chat with him. You need to know more about his portfolio and what he's done. And I like talking to guys who've done it themselves.
So personal pension plan. So is that money that I agree to not touch before retirement or something?
I can't answer these questions yet.
Yeah. Oh yeah. Okay. We're getting into.
I have to take the course. Yeah, I have to educate myself, right? So I basically had 2 really great meetings and conversations with this person who approached me, and we started sharing ideas about how things can work. And he taught me a few things in a very short period of time that I thought, wow, okay, I need to become a student of this to investigate it further and get all the ins and outs so that I can filter that information down. And first of all, the biggest thing typically with stuff like this is distilling it down into something digestible for people, right? Like a lot of this stuff, I know I'm going to take this course, and a lot of it's going to be like, very, boring stuff to try to learn and digest. But understanding the Income Tax Act, right, and learning that is not fun work. But if I can do that, and then if I can teach other people how to take advantage of the pieces of it that make sense for investors in private mortgages, then we have something great for everybody.
So you said 3 months?
3 months, yeah.
All right. I'm going to be grilling you in 3 months.
Yeah, you should set up already episodes that we have to, like, we should do a whole bunch of different episodes on the pension plan, maybe even do some as we go, so I can share what I'm learning as we go.
Done.
That'd be kind of neat. And maybe we can talk about it on these and so on. Like that, yeah, it's all kind of learned together.
I mean, I am planning on cutting ties, but couldn't hurt to
cutting ties.
Optimize.
What do you mean? Cutting ties.
Foregoing Canadian residency.
Oh, Canadian residency. Yeah.
To not.
I was like, where do you think you're going?
No. No, we've had this conversation multiple times, and
Yeah.
I'm just not happy
I'm excited for you.
with losing half my money.
Yeah.
Hmm.
Yeah. Anyways,
But,
do we have any other guests?
um,
Do we
yeah,
have
no,
any other
that.
questions? Any other questions from Neil before we kind of wrap it up?
All right, Neil. Well, thank you very much for joining. If you have one last question, we'll be happy to answer it. If not, that will be it for us.
I'm gonna go watch some baseball.
Yeah.
I'm glad the Blue Jays aren't playing.
I'm so not like what's happening with baseball right now. I thought it
You
was
have no
too
idea.
cold.
The playoffs just started. The Blue Jays are in.
Okay, he says thanks. I joined the community, so I guess he'll be on the next
Awesome.
Tuesday. Next call is Tuesday, and it's with a lawyer, I believe.
Next Tuesday is with.
I'll tell you.
Yeah, I think it is with a lawyer, enforcement lawyer.
Let's see what the topic's going to be next. One membership pending. Neil Cameron approved.
Yeah, there you go.
There you go.
Nice.
Have a look around and enjoy yourself.
Yeah.
Community roadmap. So on October 7th, what is the magnetic experience like for our investors, and how does it compare to other investments?
Oh, we have a panel of 3 investors that day.
Okay, so next Tuesday, October 7th,
Yeah.
Neil, you'll be able to hop on a call with 3 of Chris's investors, and they'll be able to share their experience.
That's awesome. That's gonna be a fun one.
All right.
Really cool. Okay. This was fun.
Yep. All right. Enjoy the game.
I'm so glad Neil joined us. We actually had a guest to talk to. That's great.
Yeah. Thanks for coming, Neil.
Okay. Talk soon.
Later. Bye-bye.
Goodbye.